So thrilled to be kicking off our 2026 investment competition. My name's Yolanda Beatty, and I am the very proud founder of Future Impact, coming into our 8th year and another cracking investment competition. In fact, breaking another record with over 1,000 registrations for participants this year. We're delighted to be bringing it to you again. I'll shortly be handing over to our speakers for the evening from CFS, TDM Growth Partners and Schroders, who will be talking through the 3 cases that we have this year. But before we do, I'll be setting the scene a little bit, giving you a bit of an overview of what's changed in the competition this year, some exciting changes that we've made, talk you through the prizes before we kick off into the individual cases. So for those who aren't familiar with Future Impact, we exist to inspire careers across funds and wealth management. And a big part of what we do is about helping students like you get your first foot in the door so you can launch careers in this fascinating industry. We think about that in 3 key pillars. Firstly, we seek to inform you about this industry, the people in it, so you can build a more nuanced understanding about markets, about career pathways, about the skills, both the technical and the behavioural, that you need to develop and demonstrate to land that first job, but also to build a flourishing career. And we do that with different information sessions, Q&As, different panel discussions, but particularly through our social media feed. So if you haven't connected with us on LinkedIn, then please do, because we share heaps of stuff on LinkedIn and also on Instagram. Our flagship event is our investment competition that we're obviously kicking off tonight. And not only is that a great way to be able to practice your technical skills in front of a range of industry leaders, but the winning team, each member of the winning team is awarded an internship or an opportunity to be shortlisted for an internship with one of our partners. But we know that it's not just about getting those coveted internships and building those technical skills. Launching a career in funds and wealth management is also about building your network. And so last year we launched Career Connect, a flash mentoring platform that gives you the opportunity to connect with professional investors and investment advisors for one-off or multiple career conversations, helping you learn what you won't find at the end of a ChatGPT search or a Google search, and what can only be discovered through conversations with people in industry. What that platform also enables, and what everything that we do enables, is early access to intern, grad, and early career roles, so that when our partners have those opportunities, we promote them where we can, or if they're running their own bespoke processes and intern nights and the like, they'll often come to us for access to the database to share those opportunities with. So it's great to have you here. Our comp is a critical part of everything that we do, and we're thrilled to have so many of you engaged in the comp this year. I've mentioned Career Connect. This is a platform that we like to think of it as analogous to Tinder meets LinkedIn. Slightly crude, but kind of gets to the point, that it's a way to build a profile as a mentee, showcase your interests and your passion, and then connect with mentors for one-off or multiple career conversations. It takes about 10 minutes to set up a profile. You choose who you meet and then have virtual coffee chats. We have over 40 companies represented on the platform, 86 mentors, and growing. We're always seeking new mentors. And since launch of those conversations last October, so coming up to nearly a year now, we've facilitated over 200 career conversations. So if you are looking to grow your network across investment management and investment advice, we've got some great advisor mentors on there as well. Then if you scan that QR code, it'll take you to the registration page. Nothing that we do at Future Impact happens without our incredible partners, and these are the organisations that not only fund what we do, but just as if not more importantly, provide access to their people to support your careers, because we know that it's only through direct access to industry that you're able to get the inside edge. And so each of these organisations participate in a range of different ways, including the organisations tonight who are doing cases for our investment competition. I mentioned things are changing a little bit this year, and we are absolutely raising the bar. We're raising the bar in response to the use of AI in your analysis and increasingly in everything that you do, and indeed everything that we all do. So we expect you to use AI. In fact, we want you to use AI to do your analysis and your research. But because AI is making the analysis and research easier and faster, we are expecting and are going to be judging you with higher expectations on your critical thinking. And so we expect you to think more deeply about your proposition and your recommendations with the additional time that you get through AI generated analysis. So what does it actually look like in terms of marking criteria and format? Well, the big change is that we are making the Q&A component of the marking criteria worth 50%. That is a significant shift. That means how you engage with the judges around your ideas will matter the most. How you learn word for word and rehearse your presentation, which we know is what you do, matters much less. It's your engagement with the concepts and your recommendation that now matters most. And so to ensure that you're best set up for success there, we're changing the presentation time so that instead of just having 10 minutes for presentation and 5 minutes for Q&A, you will now have 10 minutes for presentation and 10 minutes for Q&A. So you still get to get the rhythm of what you want to present. We know that's important to communicate your ideas, but there's a much more robust discussion expected in the Q&A time. That means that there will be 16 teams in the heats and 4 teams in the finals, down from 20 and 5 in previous years. Now, when it comes to critical thinking, what does it actually mean? It means that you need to know the so what behind all of the important numbers and assumptions, expecting the judges to be asking you to justify your recommendations at a level that requires you to really get behind those numbers, so that everything that AI spits out for you, you need to understand and be able to defend and explain. Be ready to explain why you rejected alternate views, not just your own. So as we look at this question of critical thinking, we really want you to be able to not just stand up behind your recommendation, but stand up behind other things you discounted and why, particularly if you find yourself taking a view that's against market consensus or is a little bit contrarian. Understanding why you're rejecting consensus views is really important. Now, to demonstrate your critical thinking in that 10-minute Q&A, you want to make sure your answers are short and concise and tight so you can get through more questions, because the more questions you're able to answer, the more you're able to demonstrate your thinking. Don't just leave it to 1 or 2 people to be across the detail. The judges will be marking team performance, and everyone needs to be able to answer a broad range of questions. So we know that you'll farm off different sections to different people, and you'll get AI to generate the first cut and the second cut and the third cut. Making sure that you've got all 4 of you, if you've got 4 in a team, but you can just have 2 people in it's between 2 to 4 in a team, so you choose the size that's going to work for you. But making sure everybody in the team can get across the answers is really important to be able to demonstrate that team response. And I'd be recommending that you get somebody outside of your team, even if it is an AI agent, to Q&A you before the day and practice it on the fly. Scripting your responses is not going to be enough because it's going to be organic, and we're going to be looking for how well you think on your feet. They'll be the teams that win at the end of the day. Okay, so looking at the prizes that are at stake, we have a range of different internships available this year. With, as you can see, a real bent to Sydney, reflecting where the opportunities are in our partner base. Now, of course, we have teams from all over the country participating this year, and if a non-Sydney team is successful and wins the competition, there will be a requirement for you to self-fund a relocation to Sydney. Of course, they're paid internships. And so we can negotiate that for you at the time in terms of how long the internship is if you are out of Sydney, to be able to make the most of a more condensed time period. As we understand that there are some constraints if it is an outside of Sydney team. It reflects where the market really is and where the biggest opportunities are. Okay, so I'm now going to hand over to our fabulous speakers who will be talking through the cases this evening. Starting with Romali from CFS, who's going to be talking through the real estate case, Sophia from TDM Growth Partners on an equities pitch for Uber, and then Jennifer from Schroders on an ASX listed stock CAR group. So we will pause at the end of each of the speakers for questions. We know you've been given the cases ahead of time, which is great. So we're expecting some good engagement around those questions. But we'll cut off as we need to make sure that we can get through everyone's presentations and allow time to get through all the questions. So Romali, I'm going to hand over to you and I'm going to control the slides to get us started on your real estate case study.
Thanks, Yolanda. Okay, excellent. So I'm presenting my real estate case study today, which is a real estate co-investment opportunity that we are looking to diligence. So the perspective to come at this from is, think you are an investment analyst at a super fund, which is what Colonial First State is. We are a retail super fund, and I work in the private markets team. And so really our role is to allocate capital to form our internal portfolio. So within real estate, we've got a portfolio of investments, and that involves partnerships with managers where we invest in their funds, as well as doing co-investments and investing in assets directly. And so the opportunity for you to analyze here today is that via our CFS property fund, we are looking to potentially upsize and increase our retail exposure. And we're doing this through Terralith's unlisted retail, an investment brought to us by Terralith, who we are a cornerstone investor in their unlisted retail fund. So the nickname for that is TURF. And it's really an open-ended core plus property fund, which targets income-producing retail assets across Australia. And so Terralith as a manager is coming to CFS. It's got an opportunity that it's looking at in Western Sydney called Bayview Village, which is a sub-regional shopping centre. It's classified as a non-discretionary retail asset because it's anchored by what you would consider like your major anchor tenants, which are your Coles and your Woolworths. It's what people need to go to every single day. So the demand for that asset is what you would call relatively stable and defensive through time. And it's really acting to serve as a convenience-led hub within growing neighbourhoods. Because it's a shopping centre, it's a large asset. And so Terralith is coming to CFS because it's a really big asset. It can't put up all the capital it needs to actually purchase that asset. So it's coming to CFS and saying, do you want to invest alongside the fund into this asset directly and upsize your exposure to this particular asset? So CFS is getting the opportunity to potentially consider a $25 million allocation into Bayview Village. So this would sit alongside TURF's ownership of the asset and give us a really attractive way to not only reduce fees, but to increase our retail exposure. And so one of the important things to consider as you look through the case study is portfolio construction. So at the moment, the CFS property fund is underweight retail and overweight industrial. So one of the things to think about is, how does this asset, if we do choose to invest, fit within the broader portfolio that we've built today? And so CFS is really interested in looking at this opportunity because there are some really attractive thematics here. It's really getting exposure to an asset that can be quite resilient through different economic cycles. So if you think we're going to go facing into a lower growth world, does this asset stack up well in that environment? As part of this as well, Terralith has come up with a business plan that it's looking to execute as part of this asset, because obviously as a manager, its objective is to buy the asset and then implement and improve the quality of that asset so it can exit at a higher valuation. So there'll be a series of value creation initiative that it's proposed. So your task will also be to delve into that and think about what actually is the feasibility of those value creation initiatives, and do you actually have conviction that they can deliver you a higher valuation when you look to exit that asset? So maybe we can go into the next slide and just delve into some of the things that you'll need to consider. So the task to keep in mind is that you'll be putting together an investment due diligence paper, and you'll be looking to make an investment recommendation to the CFS Investment Committee. And so just to simplify the case study here, you can assume that we've already done due diligence on Terralith as a manager, and we have conviction in their ability as a retail manager in real estate. So the task here is really to focus on the Bayview Village asset itself. And so as part of that, you'll need to consider things like, where is this asset located? Is it located in a really attractive catchment area? Does it have strong demographic tailwinds underpinning it? So think about things like that. So there'll be an element of having to conduct some market research around it, think about the thematics that this asset kind of could benefit from, and then kind of pull together your thoughts around that. Number two would be looking at those specific value creation initiatives that the manager has put forward. Think about, what are the feasibility of this? What is the execution risk? And how aligned is it to some of the broader sector trends that you're seeing? So you can consider things like e-commerce disruption, for example. The next thing, and I'll talk about this later through the pack, is that there is a model that will be built, and that's going to really help you solve for what is your expected return from this asset? What is the levered equity IRR? What's the multiple? And does the economics of that case actually stack up? The last thing to look at before you kind of put through an investment recommendation is really portfolio construction. And that's really important for what we do on the allocation side, because it really is about, how do we construct a CFS property fund that's actually going to deliver outperformance for our members? And so it's not just a question of, is this asset attractive? It's, how does this asset sit within the broader portfolio that I've built today? The next thing is just the investment recommendation. So pulling this all together, where do I think we should progress with this asset, or do we think we should actually decline to participate because it's just not the right fit for us? A key part of that, whether you decide to recommend the asset or not recommend investing in the asset, a really important part will just be considering, what are the risks involved with this and what are the actual mitigants? So depending on which way you go, that will obviously change, but one of the things that will help inform whether you recommend or not recommend the asset is, do you think the risks are too big and there's not enough mitigants to it? That's going to really help inform your view. And the other thing is, more than happy for you guys to think of any other areas or considerations that would be good, that if you were to proceed with the asset, you'd just like to understand in further detail. So very happy for you guys to flag that as you go along. Maybe we'll go into the next slide. Yes. Okay, so just to flag up front, we're going to make a little bit of a change here, and some of you guys might have clocked it, but on the last valuation here, assume that this gets done today. So the acquisition for year for this asset should actually be 2026, not 2024. So we'll update that in the materials, but this page gives you kind of what are the key characteristics of the asset itself. So you can see it's a regional shopping centre located in Blacktown. It's 20,000 square metres. It's on a fairly sizable land bank of 4.5 hectares. And the average lease term for the tenants in that shopping centre is 3.1 years. Maybe you can go then the next slide. Perfect. Terralith as the manager has also put together what it thinks is the key investment thesis underpinning this asset. I've kind of talked through a lot of these things. Obviously, as the manager looking to syndicate out some co-investment, it will have a very positive and bullish view of this asset. Your job is really to make sure you've either got to confirm, challenge, and look at this hypothesis being really objective, because the idea here is to form your own view and think really critically about whether you actually think this is a good idea to invest in the asset or not. Maybe the next slide. Okay, so this is the value creation strategy. So, like I mentioned before, the manager intends to put in more capital into this asset with the idea that it can actually improve the quality and be able to exit at a higher valuation later on. And so, some of those value creation initiatives include changing the specialty leasing mix. So, for some of your more specialty tenants within the shopping centre, what is the best mix of tenants that I can have to attract more foot traffic into my shopping centre? Thinking about things like centre upgrades, what are the little cosmetic refreshes that I can do just to enhance the facade, make things a little bit more attractive so people actually want to be in the space? And then what are the other additional more mechanical capex driven things that I can do, like loading dock? Can I utilize any additional land that I have through car parks? How do I improve my sustainability ratings? Do tenants actually care about those things? Those are the things that you're going to need to look into, and also look at whether that the spend that's been allocated actually is justified by the expected uplift that you could get from that. Next slide. Yes, thank you. Okay, and so this is the current anchor tenant mix. So you've got your anchor tenants, which are your big Coles, Woolworths, Kmart. Those are your big players in your store. Then you've got your mini majors. So these are your Pricelines, your Chemist Warehouse, and those sort of shops. And then, like I said, that specialty of tenant mix, which feeds into the value creation initiatives that they're proposing. How do we actually optimize this mix? So looking at the current tenancy breakdown and where the manager's proposing to take that to will be an important consideration in forming a recommendation. Next slide. Okay, this is the portfolio construction piece. And this is, like I said, it's quite important to consider exactly how this asset would fit into our broader portfolio. And so you can see we've got the current percentage of what our portfolio looks like today. And so we've given you the size of the asset, the potential stake that we're considering. And so there'll be an element of having to look at the portfolio as a whole and think about, does this adding to this asset actually overly expose me to a particular sector? Does it increase my single asset concentration limits to an area that I'm uncomfortable with? So you'll be able to solve for that with that target percentage of gap there. Okay, next slide. Okay, now for the model. So the model will really be one of the key pieces that will help inform your recommendation and whether actually making this investment makes sense. You've got all the inputs here that you'll need in order to complete the model. We would have given you a template beforehand. It is intended to be a relatively simplistic model, and I would recommend that everyone kind of keep it to be as simple as possible, because the idea is really for you to solve for the correct levered IRR and equity multiple, so you can actually use that as a correct input into forming your recommendation. So I would try to avoid adding any additional complexity that you don't need to add, because the risk there is that potentially you get an incorrect output that then skews your recommendation in a way that you might have not done if you put in kind of just simply calculated what you needed to calculate. So I would just caution on that front, but the model is intended to be relatively simple. And the other thing I would just mention in terms of trying to form a view around this is one of the key parts of this will also be conducting some sensitivity analysis. So what are the key drivers of returns? What's actually the biggest risk to that valuation? If NOI moves by X%, how much does that actually impact my valuation? So that will be a key part of this modeling exercise as well. I think that, yeah, yes, this will be the last slide. So this is just showing you what that template actually looks like. So like I said, it's quite a simple model, but the intention is really to make it very simple for you to solve for what is the correct return that I'm going to get from investing in this asset, and does that stack up or not? Okay.
All right, thanks, Romali. Now we'll
No
open up to
worries.
questions. Either unmute yourself with questions, or Brian, I don't know if you can see anything in the chat that I can't see because I'm sharing the screen of questions coming through.
Yep, I can just ask on behalf of the chat.
Right.
We just had a question regarding the slide limit.
No slide limit, other than you've got 10 minutes to present. So be conscious of what you can get through in 10 minutes. If you haven't done one of these competitions before, um, it's good to know that there is a lot that tends to go in the appendix, and some pretty quick whips into appendix when it comes to the Q&A discussion. So if you've only got 10 minutes to present, keep it in mind of 10, you probably don't know much more than 10 slides. So a minute a slide. The other piece of feedback that we've always heard from judges before is don't overload your slides with a million data points. The students do that all the time. You want to keep your slides high level, so you're just communicating what actually matters and the message you want to communicate on that slide. You won't get extra points for the 50 other things that you don't actually even talk about. That can go in the appendix. In the presentation, you want to keep it, sufficiently high level so you can talk to it. You've got the data on there that you're actually talking to, rather than thinking it as a detailed report. It's a useful tip. That person that's got their hand up. Does that,
I think we have another question for Romali. Do we assume that the last valuation was also March 2026?
Yes, that's correct.
And that person that's Chat Devane, do you want to unmute yourself and ask your question?
Yeah, hello. Thank you so much for the first half of the presentation. I just wanted to ask, considering there are 3 case options, are teams judged against everyone regardless of case, or is there like an equal representation you're trying to have for the finals?
Yeah, good question. We do like to have not an equal representation, but we'll pick the top 4 CFS cases, the top 4, and then top 4 TDM,
Right, okay.
top 4 Schroders, and then there's usually a mix in the other.
Okay.
And so, hot tip, people tend to favor the equities cases because you've gotten more, training on that. I think there's a little bit more at university on equities cases.
Yeah.
And
Okay.
so that's something to consider.
Okay, perfect. Thank you so much.
No problem. Orlando, and let's focus on questions for Romali now. And if you've got additional questions for me, we can keep those to the end. Orlando, did you have a question for Romali?
Hi, yes. So I was reading through the brief this morning, and for cases 2 and 3, it mentions we require public data, but for case 1, there is no mention of what sort of data we can use.
Yeah. I mean, so this Bayview Village asset is purely hypothetical. The intention of this case study is really to think about how you would invest in a real estate co-investment opportunity. So happy for you to use whatever data is available, because there's no limitations around, confidentiality, because it is a hypothetical asset that we're looking at.
Thank you.
But certainly, Romali, I think you would say, because you've got the location, so you're looking at market demographics around the location, that would be publicly available data. Obviously, all the data that's been provided to you, and other, sensible reference points, particularly around those value-adding opportunities.
Yeah, absolutely. So cast the net wide in terms of being able to inform your view. So it really will be, the data set available to you is quite unlimited, and there'll be, like to Yolanda's point, there'll be a lot of references for you in terms of retail assets that already exist within that caption in the Western Sydney and Blacktown area that you can reference as part of helping you build out this case study.
Thank you. And building on top of that, can we use things such as IBISWorld or other data behind paywalls?
Yeah, that's fine. I think. Actually, Brian, yeah, I think that's fine, isn't it? We're okay for as long as it's publicly available data.
Yeah. I think Orlando, you are a UNSW student, or UNSW students. I'm not too sure about the other unis, but we do have resources available where you could freely access IBISWorld.
Yeah, so I think most universities will have similar kind of access to paid subscriptions, but it's technically publicly available. Just and your unis give you access.
Okay, thank you.
Chi-Hin?
Hi. So I have a question about the case 1. So how complete is to provide a cash flow template, and are teams mainly expect to populate and challenge the assumptions, or just materially develop the model further?
Yeah, so the intention isn't for you to have to challenge any of the assumptions. If you think that they're incorrect, you can question that as an area of future diligence, but the idea is for you to be able to just input and fill that template out so we can actually help you solve for the correct levered IRR. And then the intention is for you to assess whether that equity return actually makes sense and whether that is reasonable for the amount of risk this asset involves. So it's really about not overcomplicating, challenging the assumptions. It's just about filling it out so you can get to those end return metrics and then be able to form your view off that.
All right, all right. So I got it. Thank you so much. Thank you.
No worries.
No problem. And Fu Trong.
Are we allowed to use other software like our Studio for calculations and data analysis if the data set is too large to handle effectively in Excel?
Yes, you can use whatever software, whatever coding, whatever you like. And like I said at the outset, we expect you to use artificial intelligence. So use all of the technology available to you so you can invest the time in really understanding the investment and your recommendations. Bye.
Hi, I want to ask, is the investment mandate of the firm a criteria, or do we just pitch buy, hold, sell on our own?
Yeah.
You should, sorry, go.
Sorry,
Emma.
you go, you go.
I was going to say your recommendation should be given in the context of the fund that so you've got to pretend you're working for Colonial First State, and your recommendation should be made, or in any of whether it's TDM or Schroders, you're making a recommendation in the context of working for these organisations, and their existing portfolios are an essential piece of context. Ben Ward.
Hi, just a question on the Bayview Village stuff. In the property summary, it says that the land area for Bayview Village is 4.5 hectares, but in the Valley Creation Strategy under development planning approval, it says that land holding is 11 hectares. Which one should we use?
Good catch. So the way to view that is that the land of the actual developed land that the Bayview Village sits on is that 4.5, but then there is underutilized land that hasn't been developed, that isn't being currently used by Bayview Village, that can then get development approvals and planning approvals and be used as part of the sales price towards the end. Yeah. So it's really a development upside that forms part of the exit valuation, but the existing land holding is at 4.5.
All right, I think is that it? Or one more question. Poor Trong, did you have another question again?
Oh, yes. I want to add one more question is like what typically differentiates the team that proceed to the hits, like is primary to the investment thesis, deep of modeling, valuation or presentation that make it different from the other team?
Brian, I might leave that to you in terms of what are you, from a unit perspective, what do you see are the critical things that get the teams that you submit through to heats?
Well, obviously there are a lot of factors that we would look at. So, because there is like a modeling component as well, prior to the screening, we'd make sure you have first of all answered the brief and have sufficiently, I don't know, included all the information, made sure that your recommendation is compelling and well justified.
All right, I'm conscious of time. Thanks, Brian. I'm going to move this on now to.
We do have a few more questions regarding the portfolios, sorry, case one specific questions.
Okay, great. Thanks.
I'll just really quickly ask these. So for case one, should we assess the $25 million co-investment purely as incremental investment, or are we encouraged to consider potential portfolio rebalancing or capital recycling from existing sector exposures? That was a long question.
No, it's a good question. I think that simplicity assume that it's incremental capital deployed into this opportunity.
Yep, and just as a follow-up, could you clarify whether the anchor or specialty leases are triple net or gross, and what rent escalation and outgoing recovery structures the participants should assume in their underwriting?
So I think I will leave that up to you guys to determine what those lease structures actually look like. I haven't gone to that level of granularity, but if you are to use that and it informs your decision, I would just put that as part of your responses. So you're very, very clear and the judges can take that into account as to how that's impacted your end recommendation.
Yeah. And just one final question from Nicholas. So the $25 million is called a 13.4 equity stake. So of equity value against an equity of $120.9 million, which is closer when calculated to 20.7%. Which basis do they intend materially changes on return math? Sorry, that question isn't grammatically correct, but I hope that made sense.
Yeah, let me come back. I'll come back to you on that one with Yolanda. Should be a percentage of the equity ticket available for the asset. But I can come back and clarify that.
Yes, thank you so much. I think we can move on to the TDM case now.
Great. Thank you, Brian. Okay, Soph, over to you.
Hi, everyone. Can you hear me okay?
Yep.
Great. My name's Sophia Croker. I'm an investment manager at TDM Growth Partners. Maybe if we just jump to the next slide, I'll just give you a quick overview of TDM. So the way that we think about investing is as business owners. There's three core aspects to that. We take a very long-term view with each of our investments. We're typically looking out 5 or 10 years and aiming to own businesses for a very long period of time. We do this in both private markets and public markets. I think the average hold in our portfolio at the moment is about 6 or 7 years, which gives you an example of that, but we have owned one thing in the portfolio for 20 years. We run a very concentrated portfolio, so we only own 10 or 15 businesses at any one point in time, which means we can focus on deeply understanding them and often providing active support, whether that's through board seats or through feedback on things like capital allocation, investor relations and communication. And it's a very, very long list of ways that we support our businesses. We've got the flexibility to invest anywhere in the world. So those 10 to 15 businesses can be Australian, they can be global and private or public, as I mentioned before. And because we're taking a very long-term view with each of our investments, one of the key parts of our thesis, or where we spend a lot of time, is unpacking the people and culture. We think that's one of the most important indicators or factors when you're investing in businesses for the long term. So we've been going for about 20 years. We run about a $2 billion portfolio, and over that 20 years, we've compounded our clients' capital at about 25% per annum. Jump to the next slide. So the case for you today is to make an investment recommendation in Uber. So I'm sure many of you are familiar with Uber, whether that's as a rider, as a consumer of Uber Eats food, potentially as a delivery driver or rides driver. It's effectively 3 marketplaces: a mobility marketplace, a delivery marketplace, and then a freight marketplace. Plus, it's also got a fast-growing advertising business and a fast-growing membership program. It did about $50 billion of bookings last year, $14 billion of revenue growing 20%, and $10 million of free cash flow growing 13%. The business has about a $160 billion market cap. As you'll see on the chart on the left, Uber's valuation has traded down over the last 12 to 18 months due to a confluence of factors. One of the big ones is that there's an open question around what the world of autonomous vehicles means to Uber's business model, as well as heightened international competition on the Uber Eats side. So as you can see down there, they're trading now at kind of 13 times EV to EBITDA, or about 18 times price to equity. So the task for you, or the challenge, is to take what you know about investing at TDM, kind of put yourself in our shoes, do your research, and then decide whether you want to make a recommendation to either invest in or buy shares in Uber, or pass on the opportunity at the current price. So I think, we're long-only investors. So, when I say pass, it doesn't mean short or sell the stock. It typically means that the price today isn't quite right. So we'd rather you make a clear call. We're very happy to buy at this price, or arguing a pass and suggesting a price that you might actually be interested in the Uber asset. So just quite a bit of a distinction there, rather than the typical buy, hold, sell that you might have done in previous case comps. If we jump to the next slide, So there's a few key questions which the market is currently debating, what I've called battlegrounds here, which impact Uber's, I guess, long-term terminal value. So there's kind of two major ones here. As I mentioned before, the big one is autonomous vehicles. What, I guess, the rise of Waymo and Tesla mean for Uber's rides network. Does Uber become a platform which all the autonomous vehicles are running through, or is it disrupted by these newer platforms or networks? Is it a winner-takes-all market, or will there be multiple winners? So this is something that the market is grappling with currently. The second one, as I said, was global delivery consolidation. There's been a lot of M&A activity in global food delivery, including Uber being involved in some of these deals. So the debate is, will reaching a certain level of scale mean that it becomes a winner-takes-most market in food delivery, or will it always be this low-moat land grab where these businesses are having to fight for market share by kind of buying new assets? So they're the main two questions, but there could also be some other battlegrounds that you uncover in your research. Oh, sorry, we'll just jump back to the other slide. There could also be some other battlegrounds that you identify in your own research, which I haven't surfaced here. But what we want you to be clear on is, I guess, picking the one or two things that you think are most important debates for the stock at the moment, stating what you believe the market view is, I guess, where the market's views head is at, and then coming up with your own view on why you agree or disagree, which then informs your investment recommendation. So you also don't have to, disagree with everything or agree with everything. It's about having kind of one unique variant perception that's genuine, rather than, I guess, multiple sort of half-baked, low conviction views. To jump to the next question, so this was all in the outline that we provided to you in terms of how we want you to frame up your investment thesis, and it's really up to you which of these factors that you weight or decide to spend the most time on based on what you know about TDM's investment approach. What I will say is, how we think about investing is this a business that we want to own for the long term, which is why we spend a lot of time thinking about people and culture, its moat or competitive advantage, and its long-term growth opportunity. And then the second part is the price today providing us with a return that clears our own hurdle over 4 years. And I believe that we put in the Pact that that's about 20% per annum over that 4-year time period. I should have mentioned this earlier, but I would also focus on just mobility and delivery. I would probably ignore the freight business for now, just given it's only 10% of Uber's overall business. So I think spending your time on the key sort of value drivers would be my tip. I think there might be one more slide. I mean, this is just a way if you want to stay connected and learn a bit more about TDM's approach. We've got a newsletter, our own podcast where we interview sort of CEOs and founders, and a website which contains more content around how we think about the world, which might be helpful for the preparation of this case. So I can pause it there. Hopefully that was a helpful verbal overlay, and then there was a lot more detail in the case study as well.
Great, thank you, Soph. Open to questions now. Brian, is there anything on the chat while people get ready to put up their hands?
Not just yet. Not any questions for now.
All right, any questions coming through? Now's your time, otherwise we will jump onto Schroders. Matthew, here they come. Matthew, you go first. Shoot.
Hi, so there's a big emphasis for our analysis to focus on like people and culture and their management, but compared to actually looking at the valuation, it's quite a qualitative sort of thing to analyze. So besides like Glassdoor and that sort of thing, how would you expect us to sort of evaluate it, since a lot of it can be biased and that sort of thing?
Yeah, it's a really good question. And I mean, there's no silver bullet here. It's really about the types of things that you want to weight. But some of the things that I would be interested in is like, what's the track record of the management team? What have they delivered to date? How have they allocated capital? Are probably two big ones for me. What's their skin in the game or level of ownership? Like, do they have aligned incentives with their shareholder base? So they're the types of things that I would be looking out for. There is a plethora of podcasts with Dara, the current CEO, where he speaks a lot about, how he thinks about leadership, how he thinks about running the business, how he thinks about scaling the culture as well, where you might actually find some more tidbits. But I agree, it is qualitative and often reliant on gut feel. So it's kind of about piecing together what you can find online with your own overlay of what you think is reasonable and right for a business of this scale and size.
Okay, thank you. If I could just ask one more question. With regard to handling the delivery hero deal, like the potential M&A, is there any sort of guide on how we want to handle it, or is it sort of open-ended on how we decide to treat it in our valuation?
Yeah, I would say that's up to you. I would assess the probability of it happening and then use that to inform how you incorporate it into your valuation. So a bit of a vague response, but that's on you to decide how it flows into your val.
Okay, thank you.
Bye.
Hi, I would like to hear you explain more about what ownership investing is and how is it different from just holding the equity.
Yeah, sure. So maybe just to do it quickly, because I was hoping that slide summarized how we think about it. I think maybe to compare how we differ to other funds, when I say ownership investing, when we're buying when we're investing, we are buying kind of portions of businesses rather than just buying shares that we can trade in and out of. So when we look to make an investment, as I said, we're hoping to own that business for 5, 10, 15, 20 years. Which means we spend a lot of time getting the big things right. As I said, kind of people and culture, long-term competitive advantage, and the long-term growth opportunity. We're not looking to move in and out of stocks. We're not looking to short stocks, which a lot of other funds do out there. It's really about kind of acting like large-scale owners of a business and taking that mentality to how we invest. The other piece is just that we're very concentrated. So rather than running a 40 to 50 stock portfolio, we're very focused on the 10 or 15 things that we own, which means, those businesses could be representing 10, 15, 20% of our portfolio rather than, 1 or 2% chunks. So hopefully there's a bit more on the slide. There's a lot more on our website about this topic as well.
Okay, thank you.
Quantong?
Yeah, hello. I just have one more question. Yeah, it's for the full-year internal rate of ratio. Should we assume an exit at the end of year 4 and apply the exit multiple to year 5?
Sorry, I didn't quite catch that question. Do you mind repeating it?
Oh yeah, just for the valuation for the full-year internal rate of return, should we assume an exit at the end of year 4 and apply the exit multiple to year 5 earnings?
Yes, I would forecast earnings 5 years out and apply a forward exit multiple to those earnings in 5 years' time.
Oh, okay, got it. Thank you.
Gregory.
Hi, yes. So under the valuation, it says to prepare like a 5-year projection. So I'm just wondering, because this is forward looking, do we just create assumptions in our financial models and then explain like how we arrive at these values? And is the judging criteria heavier on our explanation or on our values?
So I guess it's a combination of both. So we're expecting you to forecast the key drivers of the business. So assess what are the key drivers of the business and have an informed forecast for those assumptions and be able to explain them. So it's probably less about getting the right number, because there never is a right number, but being able to stand behind the reasoning and assumptions behind the forecast you put forward.
The 5-year projection will all be like our assumptions that we make and then how we justify them, right?
Yes, that's correct. And Yolanda, remind me what the valuation model is as part of the assessment criteria, what portion it represents?
It is, and I've got it on my slide, but it's now too small for my eyes to read. It is, hold on a second.
I believe it's 5.
Thank you.
Yeah.
5 out of 100. And so what we're really saying there is that, you know, you need to get that right and be confident in standing behind your numbers, but it's in how you engage with the standing behind the numbers and can demonstrate that critically that matters more than just the valuation coming out, technically correct.
Right. Okay. Thank you.
I'll just ask a quick one from the chat. Are we
Yep.
pitching the presentation as if you guys, TDM, have already done the research, or is it meant to be something that is brand new and you've never looked into before?
I would approach it as brand new.
Yep.
And if you go back to kind of the requirements of the challenge, like we do want you to give a brief business overview and be introducing it as a pitch to the team. So it should be fulsome, but obviously focusing on the key battlegrounds which I identified in the presentation.
Yep. Another question from Austin. So are we modeling an exit EV to EBITDA multiple? Can they just model down to EBITDA, or should they do a 3 financial statement model?
So as part of the rubric, it says, it asks you to select the type of exit multiple that you want to use. So that could be an EV to EBITDA, it could be a PE multiple. It's for you to, I guess, pick the multiple and then identify why you've selected that valuation multiple. And then based on that, that will direct the modeling approach that you take and what line item that you model down to. Any more?
Those were all the questions in chat. I think Vi had her hand up before.
No, I think we're
Oh, no, we
all
have a
good.
question from Kino.
All right, well, I think we're good. So Brian, I think.
Sorry, Yolanda, I think you just froze there.
Does anybody want to unmute? Sorry, whoever that person is. I can't see any hands up, Brian.
Yeah, no, Kino had her hand up and then I think she just put it down.
All right, well, if there's nothing to ask, let's get on now to Jennifer, who's going to talk us through the Schroders case study.
Great. Hi, everyone. Just a brief intro into Schroders. I'll try to go as quickly as possible to leave as much time for questions. So on this slide, I just have here that we have experience of over 222 years investing for the future. And that just tells you how old Schroders is. It's a really old company. But specifically in Australia, we've been here for a little over 60 years, so young relative to the group. But about the team, so this work that you'll be doing will be for the Schroders equities team, and we specifically run a combined portfolio of $10 billion for retail and institutional clients. Similar to TDM, we are long-term investors. We look to invest in companies and own these companies for a really long time. We've supported companies and management teams for decades in some instances, and on average, our holding time will be about 7 years. So if we could move to the next slide, please. The case study that we'll be looking at here is Car Group, and the key question that
someone might be doing that as well.
Oh,
Really?
somebody
It's
needs
like
to
that.
unmute themselves. Let me just mute them. Sorry, go, Jennifer.
No worries. The key question that you'll be answering for us is this a good candidate for the funds? So for Schroders in particular, our team were very focused on valuation. So what we want to see is your valuation and how you came to it. And ultimately, the valuation would inform whether it's going to be a buy or wait till it gets to X price, which is your valuation price. So why this is particularly interesting, similar to Uber, Car Group has been caught in the middle of the SaaS apocalypse. And that's just what's happened year to date, where people are concerned about AI basically disrupting a lot of technology businesses by people being able to make products quickly with AI, or people using these large language models as your basically your search engine. So you've read the brief. If you could move to the next slide, please. VCA.
All right. Yeah.
So the key things that we'll be looking at here that we hope comes through in the presentation is we want you to tell us about the industry and market from your perspective. So assess the long-term, perhaps start first with where we are in the online automotive marketplace, and then tell us your view on the long-term outlook for this marketplace. Then the second bit is just talk about Car Group's competitive position. So, I mean, everyone here would have probably interacted with carsales.com if you've ever tried to buy a car or tried to sell a car. So we all know car sales instinctively, but also the part that people don't really know if you're not close to the investing side of Car Group is that it goes beyond the Australia business. So Car Group has exposure to a US marketplace called Trader Interactive. It has South Korea, it has Brazil. So it's quite a big group. So we'll be interested in your view of these individual marketplaces and how Car Group fits within those places, talking about the competitive position. Then the third thing, which is the most important bit, is really we want to see your investment thesis and your valuation, how you came to whatever valuation that you've come to. So in the brief, as you've seen, we left it pretty open to you to decide what the appropriate valuation methodology would be for a company like Car. So we'll be interested if you choose an EV EBITDA or EV EBIT or DCF. But in any case, whatever valuation methodology that you choose, it would be we would want to know why and why you think that's appropriate for a Car Group. Next slide, please. So just a few things to consider. So it'll be worth considering the business model. So with your valuation and with your model, we don't have a template for you, but it would similar to TDM, it would be recommended that you keep it as simple and as top level as possible. So for Car Group, if you look at the business model, it's really a very simple volume times price. So we want to understand how you thought about what the outlook for volumes are going to be and what the outlook for price is going to be in the specific market as far as the company's disclosure gives you insight. Then we want you to talk about competitive landscapes, especially with the world of AI and how things like their network effects work for them, their pricing power, barriers to entry, all of those good stuff. Then also talk about their growth strategy, what are the risks here, and ultimately would be interested in knowing your view on the management team. So recently the CEO left Car Group to go to REA, which is a similar marketplace in Australia. So we'll be interested in your view of management quality and also about the board of directors. So next slide, please. Here, I just put a few metrics that will be interesting for you to look into when you're building the model. So like I was saying earlier, the key metrics that you need to model this company, keep it as simple as possible. It's volume and price. Then how much cost are they going to spend on top of that? So Car Group is really good with their disclosure. So you can read through what they've done historically for volume and price in Australia. And then for the other markets, you can also form a view about those. Then look at EBIT margins, free cash flow, ROIC, and all of those relevant metrics that you would have no doubt learned in your finance courses. So similar three statement model, P&L, cash flow, balance sheets. It would be great if you could model those out for a minimum of 5 years. If you're doing a DCF, then you probably want to go a bit further than that, but that depends on what valuation approach you ultimately choose to go to. Then we'd also be interested in a sensitivity analysis. So we'd want to see what you think the upside, downside, and the base case is. And realistically, we want to understand why you think those are possible bull and bear cases. So we don't just want you to give us a scenario where the company's where the valuation is like up 200% and then the best scenario where it's down 50. We would want to know, okay, what are the circumstances that play out to make this valuation realizable? Then the last slide, please. Right. So the other thing is just where to source your information. Here I just put ASX and report, Reddit, you could go on Glassdoor, really anywhere. And here I just put also time to be creative. So we would be interested in your unique sources of information. So Yolanda was talking about AI as a source. You could use that as well, but we would be very interested to see what data points or what information you can come with to present on this company. But of course, the most important caveat here is that nothing that's material and non-public. So for example, if you know someone that works at Car Group, or if your dad is the CEO of Car Group, please do not get any information from them because that will be material non-public. And well, you could get some information that's non-material, non-public, but I would try to stay away from those sources because that could potentially get you into trouble with the regulator. So get creative, but not too creative. The last slide, that was it. So open to questions.
Great, thanks. Anybody who wants to ask some questions of Jennifer? Anything on the chat already, Brian?
Is Ibisworld usually for this case? Not too sure what that means.
As in Ibisworld as a data source? Jennifer, do you use Ibisworld in your analysis?
I don't use it personally, but I'm sure it's available. If it's publicly available, then it's fair game.
Right. Joe.
Hi, maybe just talk, if you could, a little bit more about the mid-cycle cash earnings. So is that meant to be as a singular model, or like is that output that we draw from a DCF? Sorry, maybe just a little bit more clarity on that, please. Thank you.
Yeah, great question. So in a typical P&L, so you have the revenue, EBITDA, EBIT, etc. What we're interested in is how much earnings this company actually makes in cash. So a good a good plug to that, or a good anchor, is the free cash flow. So typically over time, the free cash flow would be the cash earnings of a business. But sometimes if a business has a lot more subscribers, like if they are signing up new customers and those new customers are paying upfront, the free cash flow can be higher than the earnings. So it's not perfect, but it's pretty close to what's usually the cash earnings. What we're trying to say there is, if you look at the EBITDA, after the EBITDA, the next number you get is the EBIT. But on top of that, you have DNA. So in the DNA, there's a part of it that's cash. There's a part of it that in the future they have to spend to replenish the PP&E or replenish the software developers' expenses, whatever. So what we want you to make a judgment there on is what part of DNA is not cash, like what part of this would they not have to spend in the future, and that number, take it out of or rather add it back to the EBIT, and that's the cash EBIT. So based on that, that's the number that you would use if you were using a multiple version. So if you were saying EV EBIT or EV cash EBIT, whatever multiple you apply, we want you to apply to that number.
Perfect, thank you.
Gregory.
Yes. If we decide to construct a DCF, would it strengthen our presentation if we cross-check it with a different valuation method? If so, and the comparison reviews like weaknesses in our DCF, is it wiser to point out the weaknesses or take a stance to support the DCF with other justification?
Yeah, that's a good point. You can absolutely do that. So one other way you can go about it is, if you do a DCF, you could say this is the multiple that the DCF valuation is implying. So you also have your EBITDA or EBIT or whatever that goes into DCF. So you could take that valuation, which is market cap, and then divide, which is the enterprise value, and divide it by your earnings that you have in your terminal year, and just say this is the multiple that our DCF value is implying. But to your question specifically, can you use multiples as well as a DCF? Absolutely.
Okay. Okay. Do we have to like take a stand whether to support like the DCF or maybe the multiple? Because if one method shows a weakness, how do we like do we reconcile the information and choose to go with one method and then say that this is like we lean to it this more, we recommend this, or should we like weigh the like the pros and cons of both?
Well, I wouldn't spend too much time laboring the point on which valuation methodology is the most appropriate, because I think you only have 10 minutes to present. But also, I think you can also just say what you think the most appropriate method is for this company in particular. So when you go through the numbers and you build out the DCF and you come to what multiple you think is appropriate, you can then just say, this is what we think the most appropriate valuation approach is. So I'll put it back to you in that instance for you to make a judgment call on what you think the most appropriate version is. So you can either do this is most appropriate or use both of them or do an average, but that's fully up to your discretion.
All right. Okay. Thank you.
Chi Hin.
Yeah, hi. So I have a question on the free statement model. So when you ask for a 5+ year of the profit and loss, cash flow and balance sheet model, are you expecting a fully integrated free statement model or forecast of the key line items? So that's just significant to support the valuation we made.
A fully integrated 3-statement model.
All right. So, all right. Okay. Thank you.
And Ping.
Hi, I just want to clarify upon the previous question. So on the guidelines, it says calculate a per share valuation based on your model and an appropriate valuation methodology, which in this examples of models such as EV versus EBITDA, EV versus EBIT, or discounted cash flow. So is it okay? Based on previous answers to the previous questions, was it okay to use multiple models and justify why we think it's appropriate in this case to use multiple models instead of only like one particular model?
So you can start out with doing all three, which, to be fair, doing EV, EBITDA, EV, EBIT is less intensive than doing a discounted cash flow. Because if you are doing a full long-term DCF, it requires you to do multiple years of forecasts. While EV, EBITDA, just assume an appropriate multiple by either using pair multiples or just using historical multiples. So in practice, the multiple approach is less intensive than using the DCF. So it's not going to be the same level of effort to do all three that it would be to do a DCF. So I think, again, this will be purely a judgment call to you, what you think would give you the best outcome, or at least better show off your understanding of the company. Personally, if I were in your shoes, I'll probably just do all three because it's a group project. So you can just have a look at the three different outcomes and then say this is valuation and this is the methodology that we think is the most appropriate for car group. But of course, at the start, you can just pick one and go with that.
Yeah, hot tip. I don't think anybody's not done a DCF when it comes to an equities pitch. So yeah, I think if you're going to do anything, you'd start with that and test it against the others.
All right, thank you.
Brian, is there anything else on the chat?
No, I think she has her hand up.
Chi, was that a hand up still from the last question, or did you have a new question?
Oh yeah. I have the last question about the international business. So, how granular do you expect from the forecast to be by geography or business segment, or is to consolidate forecasting acceptable when justified?
I think I'll also leave that to you to your discretion. If you ask me what I would do in that instance, I would probably model each geography because so while I say CAR gives you detail on volume and yield for each individual geography for their business, they don't do it for each area. So for the US, they don't give you volume and yield. For South Korea and Brazil, they don't give you that level of detail. So for those business lines, what you probably have to model there is what you think revenue is going to be and what you think the EBITDA is going to be for those specific areas. It's Australia where you get the very great detail on this is the yield, this is the volume, this is what we get from dealers, from private, etc. So Australia is a bit more intricate, but the rest are just revenue and costs. So in that instance, you can choose to do Australia in great detail and group all of them together, or you can choose to do each geography individually. That will also come across in when you are doing your specific analysis of each individual area. So, for example, you could do the work and realize that the US is a huge opportunity area. So, if that's what you're saying and what you're presenting to us, we would want to see what you think the US revenue and US earnings is going to be. And if you conversely say, okay, Brazil is a big opportunity area, then we would also want to see what you think the revenue and earnings for that business region is going to be. So it also depends on what your thesis works out to be.
All right, I think it's solved my problems. Thank you.
Thanks, Chi. Brian, is there anything else? Any other questions on the chat?
Yeah. So given four currencies, would they be expected to build the model with a built-in AUD with FX assumptions or segment level local currency rolled up?
Car reports everything in AUD, so I'll probably keep it simple and just use the base reporting in AUD and roll forward. No need to worry about FX assumptions.
And Joe, I think you had your hand up, and then you took it back down. There was no question from you there.
Yeah, it was just maybe it was kind of following up on that question, just that, especially with the previous case two, it's on the New York Stock Exchange. So would just the president be okay to use, even if it's USD, for example? Or would you prefer it to be Australian dollars? That's more the case two though, and I guess maybe it applies to this one as well.
So, Soph, if you're still there, do you have a view on currency to report in? So,
Hi, Uber reports in US dollars, and any materials that they've released on potential M&A as well, I think has all been converted to USD. So I would just stick with the reported currency for simplicity.
Perfect. Thank you.
All right, Brian, is there anything else there in the chat?
Not that I see, no.
Okay, great. Excellent. All right. So final steps from me. So you've got all the details, and I'm so glad we sent that out earlier today because the engagement in the questions tonight has been fantastic. So I'm so looking forward to seeing how that translates into some really great presentations. This information session has been recorded and it will be shared to you for you tomorrow to be able to share it with your teammates and have it support your preparation of your submission. Those submissions are due on the 27th of August. You'll note that's a little bit earlier in terms of when the heats is on because we're making sure the judges all have a little bit longer time to review sorry, no, I'm jumping ahead. Submissions due 27th of August. You will be notified on the 31st of August. And then we're giving a little bit of extra time when we need for the judges to be able to evaluate any final submissions. So you can make a few changes, but we must have the final presentations to the judges by the 1st so that they have 48 hours to prepare for good, robust Q&A. The finals event is at Schroders in the Sydney office on the 10th of September. And again, for those that are confirmed that who move from finals to heats, you'll have time to adjust your presentations, but we will need finals presentations on the 48 hours ahead to give finals judges time to prepare those Q&As for that finals evening. If there aren't any other questions for me on process or any kind of criteria or anything else, nothing else that's come through there, Brian?
There are a few questions. So Haley asked, she had a question regarding the presentation itself. Is there a strict specific structure for the presentation with regards to the slides?
No specific structure. You are encouraged to, use your own judgment there, recognizing obviously the cases have given you some direction in terms of what's important to them. So covering off what those cases want you to cover in the way that you deem to be most logical to justify your recommendation.
Yep, and another one, I didn't realize this beforehand, but I realized I won't be able to attend the finals should my team get there. Is there anything I can do in this case? Is she able to call in via Zoom?
No, you need to be able to be there in person.
Yep. I just had one more point to raise. So I think in the case brief we did mention, if you read under the submissions, it says to submit your submission as a PowerPoint, but that's specific to the final submission. So make sure when you're submitting your initial case, so your presentation, make sure to submit it in PDF form. Orlando has another question. Are we able to change team members if someone has to pull out?
Yeah, of course. I mean, who comes together as the final team for the heats? You can figure that by the 27th of August, right? And if you need help in juggling teams because from unit because you've been brought together in a team from unit, then reach out to Brian and the team and they'll work that up for you. But you want to obviously get that finalized as soon as possible because you've got to work on the case together. Any other questions on logistics or process?
Another question, I believe this was already answered. Is there a limit to the number of slides? No. But I think, Yolanda, you already mentioned, try to resist the urge on having too much information on your slides. We'd much rather see a clearer, well-supported view with lots of research, than lots of research just packed into a single page. So try to implement charts, graphs.
Yep.
And yes, you're supposed to only submit a PDF for your slide deck and then a model as well. PDF slide deck.
And Excel or whatever modeling software you're using.
Will there be a specific email to contact for teams made from unit? Yes, it is all in the case brief. I believe it is just unsw@unit.org.au. So if you have any questions, just make sure to send an email via that address. Do we have any page limits in financial model? No, there isn't. Yolanda, just a question on references and bibliography.
Yeah, that should be in your appendix. Yeah. And I should mention as well that regardless of where you're located, you are flown to the Schroeder's office for finals night.
Yep, so I think that's just to address Gemma's point. If you can't make it, you will have the optionality of getting flown over.
Yeah.
Any AI acknowledgements?
I think we would assume we're just assuming you're using AI if there's a particular, and so therefore you obviously need to be checking everything that much more diligently because of the tendency for AI to get things wrong. But if there are specific skill sheets you're using or AI references that you think would be useful for the judges to know, then feel free to put them in. But again, we're expecting you to use it. You won't be penalised because we're expecting your critical thinking to be even higher.
Yep, and just to address Alexander's point, no, you will not be doing any presentations until you reach and progress to the heat stage.
All right. Is that it?
Oh, one more. As IBIS World is allowed, is there any limitation to what university resources, programs, or sources that aren't allowed?
No, anything that your uni has and makes available to you, you should make it, you should avail yourself of all of the software, data, tools, and platforms you can.
For example, a Bloomberg terminal.
If your university has a Bloomberg terminal, then you should use a Bloomberg terminal.
Yep. And Brian, just to address your question, there are 16 teams that can be qualified into the heats round. I would just like to note that this year we have had like record-breaking numbers, over 1,000 registrations. So don't feel too bummed out if you don't actually end up making it past heats.
And don't let that number turn you off from submitting as
Yes,
well.
definitely
The
as well.
process, yeah, the process of submitting, should hopefully be a fun and educational process as it is. We run this competition every year, and so every year you get better at it. So if it's your first time, don't let that intimidate you.
And it is a learning experience as well, definitely. Individual number of people, Madison.
All right, it sounds like we're coming to the end. All right. It looks like we are good to go, and 5 minutes earlier, which my children will be happy about.
Fiona had a quick question.
Yep.
Does the program interfere if there's an uneven distribution of work done by group members, or for example, one person does significantly less?
Well, Fiona, that will really be picked up in your Q&A. So you definitely want to make sure everyone can answer those questions evenly. And also, you don't have to have 4 team members. The only requirement that we have is 50% of those team members are women. And so, one year we had a winning team that was 2, 1 woman, 1 man. And that team actually had some of the best slides that were not dense with data and detail. And 2 of those 2 have gone off to multiple internships, multiple part-time roles. So you don't have to have 4 people. You just must have 50% women. So if that's a team of 3, to point the obvious out, that means you need 2 of them as women. So don't force it to 4 if you don't think all 4 of you are going to equally contribute. All right. I think we are all good. Excellent. All right. Thanks everybody for joining us tonight. And looking forward to seeing all the submissions come in. Don't forget to, if you are in Sydney, to come to mark the finals night in your diary, as even if you don't make it to the finals, there's opportunity to attend. Thank you again to our wonderful partners that have contributed to tonight and to everything that we do at Future Impact. Good night for now, and we will see you shortly. Bye for now.